Enron was once a symbol of corporate innovation in the energy sector, a titan with ambitions that reached beyond just selling power. But behind the glossy reports and soaring stock prices, a web of deceit was being spun, leading to one of the most spectacular corporate collapses in history. Today, we dissect the rise, the scandal, and the aftermath of Enron's dramatic downfall. Founded in 1985, Enron began as a modest energy supplier, but quickly reinvented itself into a global powerhouse. It wasn't just a company, it was a brand synonymous with innovation, risk-taking, and market disruption. Enron aimed to revolutionize the energy industry by creating new financial markets for energy trading, touting itself as a pioneer in the deregulated energy sector. At its peak, Enron was not only known for its vast revenues, over $150 billion annually, but also for its ambitious goal to become the world's leading energy network. But to sustain its skyrocketing image, Enron's executives resorted to some of the most convoluted and deceptive financial practices in modern history. Their two primary tactics were mark-to-market accounting. Enron would record projected future profits as current income. Imagine booking next year's revenue today, a practice that artificially inflated their earnings. Special Purpose Entities, SPEs. They established off-the-books companies to hide massive amounts of debt. Reports suggest over $7 billion in liabilities were obscured this way. Additionally, the practice of round-trip trading further distorted their revenue figures. In these deals, Enron would sell energy to a partner and then immediately repurchase it at the same price, essentially generating fake revenue figures without any real economic substance. Suspicion began to mount when internal documents and whistleblower emails started hinting at inconsistencies. Analysts on Wall Street noticed discrepancies between Enron's glowing quarterly reports and the underlying financial data. As the pressure built, regulators and investigative journalists dug deeper. When Enron declared bankruptcy in December 2001, the FBI and other agencies mobilized an unprecedented investigation. Over 45 agents conducted 1,800 interviews and collected more than 3,000 boxes of evidence, equivalent to over 4 terabytes of digital data, revealing thousands of questionable transactions and a systematic web of financial misrepresentation. The immediate fallout was explosive. In December 2001, Enron filed for bankruptcy, the largest in U.S. history at that time. The impact was swift and devastating. Stock price crash. Enron's market capitalization, which had once soared above $70 billion, collapsed to nearly zero within weeks, obliterating investor wealth overnight. Massive job losses. Thousands of employees were left without jobs, and many saw their retirement savings evaporate as pension funds tied to Enron's success crumbled. Criminal charges. High-ranking executives, including CEO Kenneth Lay and CFO Andrew Fastow, were indicted on multiple charges. Dozens of other senior managers faced legal action, and billions in assets were seized in the pursuit of restitution. While the immediate shock of Enron's collapse was staggering, the long-term repercussions reshaped the corporate landscape. In response to the scandal, regulatory reforms, the U.S. government enacted the Sarbanes-Oxley Act of 2002, a sweeping reform aimed at enhancing transparency, enforcing stricter auditing practices, and holding executives accountable for financial misconduct. This reform fundamentally changed how companies report their earnings and manage internal controls. Market and investor confidence. The scandal led to a significant loss of trust in the financial markets, prompting investors to demand more rigorous scrutiny and better disclosure practices in corporate reporting. The collapse of Enron stands as a landmark case in corporate fraud, an intricate house of cards built on deceptive financial engineering. With every layer of false accounting unwrapped by rigorous investigations, Enron's downfall not only reshaped regulations, but also left an indelible mark on financial oversight. This case remains a vital study in the power of data, the importance of transparency, and the complexities of modern financial systems. Thank you for watching this video. Remember to hit the like button, subscribe, and turn on notifications for more interesting stories.